Hey guys, this is Dave with Moniology. Hope everyone is having a great weekend. This is the weekend market review for the weekend of October 7th and 8th, 2017. For those of you who are new to our videos, what we like to do is take a look at some of the more important sectors in the market from multiple time frames, that is daily, weekly, and monthly, to get a better gauge of what's going on in the markets, where we've been, where we are, and where we're likely going. And these have been a very, very good predictor of very, very important sectors in the market, such as interest rates, oil, and the dollar. If you've watched these since June, we've been spot on basically on the dollar, interest rates, and oil. And while that's no guarantee that this is going to be will be accurate in the future, I think our approach does remove a lot of the noise in the market, gives you a better perspective, and allows you to trade along with the trends. And if you are just managing portfolios, it allows you to potentially reduce some risk where necessary. So let's have a look at some of the sectors that we're looking at today. So starting with the 10-year U.S. Treasury yield on the daily chart. We've been calling a very, very nice run in Treasury yields once we broke out of this downtrend. And while we anticipate eventually hitting this 26 line on Treasury yields, ultimately this particular shooting star candle suggests we might have a couple of days, if not weeks, of a pullback to allow some of this overbought condition to correct itself. Now, no surprise it's happening here. Why? Well, because this 69 to 70 RSI level is coincidental with the level that we hit here, and we met fairly stiff resistance. Moreover, there's kind of a divergence here where we haven't met, we didn't reach this 24 level, and yet actually it's a positive divergence where we hit this 24 level here. We were just above 70, now we're around that level, and we're not yet at that price. Overall, interest yields are in a positive trajectory, but they might pull back for a couple of weeks here. Taking a look at the weekly chart, broader perspective, we've broken out of this bullish flag, very bullish developments, but again, we might pull back here. It's possible that we'll even retest this breakout from the upside. Having a look at, and one additional point, MACDs have finally crossed zero on the weekly chart, which gives further credence to the bullish argument. But what is very often happens is once we break out of this above zero on the MACDs, we have a snapback correction to the level of breakout. This is something that we've noticed. It's possible that whoever trades these markets has seen these sort of breakouts happen again when the MACDs cross zero, and then they like to shake out some of the weak speculative hands. So may happen here again, especially with that shooting star candle on the daily chart. Monthly is starting to look like it's going to break out very, very soon in the coming months ahead. For the next leg higher, we need to see that 25 level breakout, but it's very possible that the 30 level will be tagged at some point this year. Bottom line is interest rates are moving higher, inflation is here, and if you're in fixed income and you're long fixed income and you're trading it, I think you may want to reconsider that particular market position. Gold daily here. We found support right below that 50, or rather 200 EMA at 1265. We broke below it, shook out some weak hands that had their stop losses right below or right at the 200 EMA. No surprise there. And now we had a nice hammer pattern here, and it looks like this corrective pattern may be over. We just shot a precious metals sector review, so have a look at that one at our Moniology YouTube page. But what we're seeing is a lot of bottoming action, a lot of individual miners, and we're starting to see that here again in the gold daily chart. Now the gold weekly chart, we've been in a very, very bullish uptrend. We're in the early innings of a major gold bull run, kind of resumption of the bull run that started from 2000 all the way through 2011. Had a 5-year pullback, and now we're starting to run again here. And we just retraced this breakout here in August very, very perfectly, and now it looks like this correction is over. So precious metals, gold in particular, is an area you really want to look at very strongly. Gold monthly, a lot of folks started pointing out that this was a false breakout and possible resumption of the downtrend. I disagree. I think there's a lot of momentum. Looking at price alone is not sufficient in our opinion. We got to look at volume. We got to look at momentum, and momentum is suggesting we are moving higher rather than pulling back lower. So definitely want to be on this train as it moves higher. Now, taking a look at junk bonds on the daily chart, we're seeing some weakness. We're seeing some pullback in RSI, and if this breaks below 60, expect to see that middle Bollinger Band on the daily at 37 being tested. This is a very, very good barometer of the credit of the overall economy, and while we might have a short-term pullback, there's nothing that I see here that suggests that the economy or the markets are weak in any way. Now, I've been pointing this out for multiple weeks now, multiple videos. The junk bond weekly is concerning because we broke down below this bearish wedge pattern, and now we're retesting it from the downside. If this 37 to 38 area cannot be taken out from the downside, this likely resumes its corrective pattern lower. We are seeing some pretty substantial divergences developing, and if this can't break higher, then expect to see lower prices in junk bonds. On a monthly level, it looks very bullish, and at this point there's nothing to see here. One thing I'll point out is the volume is kind of low here in the last several months. Could that be predictive of a pullback, longer term pullback in junk bonds? We'll see. Crude oil daily. Now, crude oil had a very nasty hammer candle here on Friday here, and we'll see what happens. There's some pretty nice support here on the 50 and the 200 daily EMA around that 48.50 to 49 level. If those get taken out, possibly we'll go as low as 48 before we find some support. Looks like with the RSI crossing below 50, we're likely going to head lower to that 38 level. But for us, and we'll see on the weekly charts, there's nothing to suggest that oil is going to move substantially lower. I think this is just a corrective pullback as we retest the 50 level from the upside. The middle Bollinger Band is around that 47.74 level. That might be an area of support, but use these opportunities to add to longs rather than exit longs. And we think oil is going to hit 60 in the coming months ahead. Why? And one of the reasons is this inverse head and shoulders pattern that's been developing, and we're just right under consolidating around that 50 on the RSI, on the monthly RSI. Once that breaks to the upside, this is going to be an extremely strong move, assuming it can break out. But we think the probability is growing that it will break out. I'm not going to go too much detail into NASDAQ, S&P, and the Russell without just briefly saying that they all look very, very strong, and there's nothing to suggest on my end that things are looking weak in any way. Just point out on the weekly there's a slight negative divergence where we're breaking out to all-time highs, but at this point RSI has not confirmed this breakout. Monthly, it's exceptionally bullish pattern, but we did break down below this bearish wedge. Now we're retesting it from the downside. Let's stay tuned to see what happens here on the NASDAQ. One point I will say is the MACDs are starting to curl lower towards zero. That's something to take a look at. The Russell looks fantastic. A lot of positive divergences actually on the Russell weekly, so that's a sector that we've been calling on since several weeks ago, and we think that there's still some relative advantage to playing the Russell over the S&P or the NASDAQ. And looking at the S&P, very bullish. Volume is strong, breaking out to new highs. RSI is confirming, and so the S&P looks great. S&P monthly, very, very overbought. I would not be initiating core long holdings at this point, but at the same time, there's no reason to suggest we can't go higher. Now the tips to tilts ratio is what we look at to gauge inflation, and this is one of the indicators that have suggested that inflation is indeed picking up steam. We're above the 200 EMA on this relative ratio. The middle Bollinger Band is curling upward. RSI has broken above the 60 level, and we've got some very nice upside in this ratio in the weeks ahead. On the weekly level, we're above the 50. We've broken above this bullish flag pattern, this kind of cup and handle here, and there's more upside where inflation is concerned. On the monthly chart, we're also breaking out here. So what this tells me is that you want to be looking at commodities, both agricultural commodities, precious metals, anything that's going to protect your purchasing power in the coming months and years ahead is where you want to be consider allocating some very nice proportion of your capital. Now the US dollar, we've called this bottom here after a very nasty correction, which we also called as well. Now we may see some weakness in the dollar after this very nice rally here. We may go as high as this 94 to 96 level, but I think this dollar rally is coming to an end in the coming weeks ahead. Why do we say that? Well, there's a lot of resistance here right up ahead. There's the 50 EMA at 96. There's the middle Bollinger Band around 94. So it may have a little bit more room to go, possibly as test that 50 RSI from the downside. But ultimately, we think this resumes lower. The one thing I will point out is the weekly MACDs have indeed crossed zero, so we may see some additional weeks of strength in the U.S. dollar. U.S. dollar monthly, it's starting to show some legs, but ultimately, if it can't break above this 50 on the monthly RSI, and that may take a couple months to retest from the downside, that likely means that there'll be significant downside pressure in the coming months ahead. Volatility, starting to see a little bit of signs of life here, as there's a nice candle on Friday. RSI is starting to pick up to the upside. MACDs are starting to curl above zero, so wouldn't be surprised to see a couple of weeks of down movements in the markets based strictly on this volatility index gauge. And but until then, there's no reason to play this long. Until this breaks 10 on the weekly chart, we assume that everything's going to continue to play out the way it has been. And that's about it on volatility. Finally, the last chart here we're going to take a look at is the world index, excluding the U.S. It's been pulling back a little bit. It's been creating some lower highs in RSI, and so we may see a couple weeks of pullback here again in the world markets. We've been pointing out how we broke below this particular uptrend, and now we're kind of retesting it from the upside, from the downside. We've got a couple of red candles here, and a couple of lower lows, three consecutive lower lows on the weekly RSI. So some divergence there, something to look out for. Finally, on the monthly chart, looks good. But you don't want to see a rollover here, because this is where we rolled over last time in about 2014. Could this be a double RSI top here on the weekly chart, or rather on the monthly chart? It's possible. It's been a level of resistance that we haven't been able to break through multiple times here in 2008. This is the level where we really crashed from, so no surprise that this is where we're finding resistance. 2014 we tried to break out, we couldn't. Now we're at the same exact point, and now we're finding resistance. So you want to see this break higher, and then a run towards 2400 is most definitely in the cards. If it doesn't break higher, that's a sign. If we break below 1900, that's a sign to get out of your tradable positions in the world indices. Bottom line is, guys, bullish overall equity markets at this point, seeing some slight consolidation and pullbacks in longer-term treasuries. Precious metals and commodities look good, and ultimately pretty stable markets overall That's really all we're looking at this point. Thanks for following us and watching our videos. Stock Twits at Moniology, Twitter at Moniology, YouTube. Please subscribe to our videos at Moniology. And for those of you who are not familiar, we do have a Patreon campaign going on here. That's where we support our videos, and your support for our videos will allow us to create better content more often, and create a really nice website, and build a community around what we're looking to do. Bottom line is we're looking to help you make money, so if you support our work on Patreon, we will do our best to help you reach your trading goals. Thanks guys for watching. Have a wonderful week, and please do support the Patreon campaign. The link will be in the show notes below. Take care.